Today I will show you my favorite candlestick pattern. We take a look at liquidity trading, and I will show you a complete top-down trading strategy on how to find entries with this approach. So let me first show you the general idea of the trading pattern, and then I will show you a top-down approach. So what we see here is the market has been in an uptrend, the market moved lower, and then we are shooting back inside the highs. We are taking out the highs. A lot of traders will refer to this as a liquidity zone. Why is that the case? Because a lot of traders will have stops and targets above the highs that we are seeing here. What you'll often see is such a long candle. I will call this candle a trap candle. The candle makes it look like the market is ready to break out. And at this point, we can see a lot of bullishness. This is probably going to lure in a lot of traders taking breakouts. Also, a lot of traders who are already short, who have their stops in this liquidity zone above the highs, will probably be taken out or are under a lot of pressure. Then the next concept that we're seeing is deceleration. Deceleration just means that the market and the price action is slowing down. We see that after this huge trap candle, which makes it look like we are breaking out, the price is immediately slowing down. We would expect naturally a follow-through, so the market continuing after this huge candle. This is clearly not the case, and the market is slowing down. Deceleration is a very important concept at those key levels. Then what we also want to see is reverse acceleration. So the market is shooting higher, slowing down, which we are calling deceleration, and then accelerating to the way down. You may have heard the famous trading quote, "Volatility is greatest at turning points." And this is exactly what is happening here. You can see that we are suddenly seeing a lot of candlestick wicks, which are the fluctuations in the markets, and we're referring to this as volatility. So there's a big change going on. There's a huge battle between the buyers and the sellers happening here, which is pointing towards a market shift. And then you can see afterwards the market is really rolling over and a new downtrend is starting. So this pattern is really important to observe at turning points. Let's look at another example before we go into the trading strategy. We're seeing again a very important market high. Here is a swing high. The market is showing us here the trap candle above the liquidity area. Really strong price action. It makes it look like the market is breaking out, and a lot of traders will be lured in to take long entries here on their breakouts. Then we're seeing deceleration. The market is immediately after the long candle slowing down. This is something that is probably going to make a lot of traders wonder whether this is a valid breakout candle or not. However, what we don't see is reverse acceleration. After the deceleration, if this is turning into a fake breakout, you will often see acceleration to the downside, and this is a must-have criteria. If you don't have that, the chances of this turning into a fake out are very low. You want to see that the market is closing lower here. This is not the case. We don't have reverse acceleration. And the market is shooting higher, giving us first this engulfing candle and then breaking into new highs. And the market continues higher. This is a great example for why we not only need deceleration, but the reverse acceleration, the increase in volatility, and the move lower against here this strong trap candle is a must-have criteria. So let's try to put this together in some trade examples. We are seeing here on this chart a very important low. It has been a swing low here, it has been a multiple swing low here, and the market shot up from this level multiple times. We're referring to this as the liquidity zone because a lot of traders will have stops and entry orders below this level. When we zoom in here on the current price action, we're seeing the trap candle. Suddenly, whereas previously the market was moving moderately lower, we see this huge candle. This is the trap candle pushing through the previous lows. This again makes it look like the market is breaking to the downside. However, we want to be patient and we want to observe carefully the price action around such key levels. We are then seeing deceleration in the form of first this doji with a very large wick, and the market is then in the next candle showing us here another inside candle. So clearly after the trap candle, the sentiment seems to be changing and there's no immediate follow through. So we have deceleration, which is great. Then we are seeing reverse acceleration. Reverse acceleration is pointing here to the upside. We have a candle that is closing very, very high, almost as the absolute high of this candle. So we're seeing not only deceleration, but also reverse acceleration. Then you can see the market is pushing higher, breaking highs, and here after this consolidation, breaking out of this range once again. And this is then a high probability scenario where you can expect more bullishness to come. So it's a very straightforward approach, you do need to be patient, but that's the name of the game. As traders, we need to be patient. And once all of criteria fall into place, you're often looking at high probability scenarios. Let's take a look at another example. What we're seeing here is that the market is in an uptrend. The market broke here the previous high, made it move higher, and now we are retracing. We're keeping that in mind. That is the previous resistance area, which has not been retested. The market is moving into the previous resistance, and a lot of traders expect this to be holding as support, and they're looking for buying opportunities. We're seeing a small deceleration here. We don't have a trap candle, and we have no reverse acceleration, right? So we need to be patient. Patience is often going to save you a lot of money, a lot of troubles, and also protecting your mental capital, because waiting for the right conditions to emerge is one of the most important skills in your trading. So here we have the trap pattern, which is moving lower very, very quickly, and then the deceleration is happening here. So we're having a few criteria that we need. We have the market pushing below a very important past level. We are here seeing the trap candle, and we have the deceleration. Now we're seeing the reverse acceleration to the upside, and the market is closing back above this level. We can go to the lower time frame, whereas previously this is the 4-hour time frame. We are now on the 15-minute time frame. This is the higher time frame level. Here are previous swing highs, which the market is breaking above. We see that we have small consolidations breaking up to the upside, and the market seems to be moving higher. Now we want to start tracking our trading plans, and we want to look for an entry signal. Shortly after, the market is in a sideways range, and we have a very well-defined resistance to the upside, and we have a good support level. Here is an example of a fake out candle where the market is first pushing below the lows here, also taking out a lot of stops here, and another fake out. And then in the same candle is shooting higher. And this is then our entry candle. Some traders may now say, this is way too late, you have already missed the boat, the price has returned. However, what we're doing here is, when you remember in the beginning, this is the higher time frame picture. We are in a long-term uptrend. And also what we're doing here is we're entering on a pullback. So we are going with the long-term trend, and we're entering here on a pullback with a very low discounted price. So this is a great example of, yes, you need to be patient a little bit. However, when you catch the trend following move, and this is what happened after here, this fake out candle, you will often see another continuation, and the next impulsive leg in the uptrending trend leg is then taking place.